because this is one rare occasion where the global team of Vaibhav Global is physically present here with us. And I, being a part of this team, I am feeling obliged for this. We have with us my friend Prashant, who will be introducing the entire team of the company, and thereafter we'll proceed with the speaker. Prashant, please.
Thank you, Amit. Thank you for the kind words. Hello everyone for taking out time and joining the Investor Day of AffordableRobotic. It's been so quite long. We have not met each other, and I think so. Again, so this is a very good time that we have got affordable management under one roof at the same time, not virtually but physically. So allow me to introduce the management of VGL. So we have Mr. Sunil Agrawal, our Managing Director of VGL Group, and we have Mr. Panwar, he is our Group CFO. Right? We have Deepak Mishra, he is the Managing Director of Shop NC Germany, the German operations. We have Mr. Shrikant Jha, he is the Managing Director of TJC UK. We have Mr. Vineet Ganeriwala, he is the President of Shop NC US operations. We have Mr. Pushpendra Singh, he is the Global HR Head, Vice President, VGL Group. And we have our backbone of the company, so he is Mr. Raj Singh, the Global Supply Chain Head of VGL Group. So thank you for taking your time. Amit, over to you, please.
Thank you, Prashant. And you already introduced Prashant as being the head of IR from within Vaibhav Global. Before we proceed, one small request. Kindly put your mobile phone on the silent mode. It was just a reminder because we tried and result to differ materially from our expectations. These factors include, but are not limited to, general market, macroeconomic, government and regulatory trends, movements in currency exchanges and interest rates, competitive pressures, technological developments, changes in financial conditions of third party dealing with us, legislative developments and other key factors that could affect our business and financial performance. Vaibhav Global Limited undertakes no obligations to periodically revise any forward-looking statements to reflect future or likely events or circumstances. With this disclaimer, I would like now to hand over the podium and microphone to Sunil. Please, sir.
Team that we have. Welcome to Vaibhav Global Limited, a global digital retailer on TV and digital platforms engaged in e-tailing of fashion jewelry, lifestyle products and accessories. Today, we reach out to 142 million households in the US, UK and Germany, with a customer base of 500,000. In 2021, we launched retail operations in Germany, and within 1.5 years, we have covered almost 90% of households. Let's have a brief look at our manufacturing base. Let's take a brief tour to our journey of evolution, a rich experience of 4 decades. expand the distribution channel, the company adopted omni-channel strategy through digital means like applications, marketplaces, social media, and over-the-top, that is, OTT platforms. Today, the digital segment contributes approximately 37% to global revenue. In 2021, we re-entered Germany, a much bigger territory with huge growth potential. We have been investing heavily in strengthening our digital capabilities by upgrading our tech infrastructure. In the UK, we strengthened our visibility and upgraded our channel position to number 22 from 50. ESG, a responsible corporate citizen. Nurturing children's health and delivering joy. The journey towards carbon neutrality. Ethical, transparent, high benchmarked corporate governance. Value creation for our stakeholders.
Our vision is to be the leading value leader of the retail industry within the jewelry and lifestyle segments in the countries that we address, US, UK, and Germany today. Our mission is to deliver 1 million meals per school day to the children in need by financial year 2031-32, financial year 31, through our 1-for-1 meal program called Hero for Choose Feeds. Our core values are very dear to us, and we hire, promote, and if need be, exit based on these core values. They are positive attitude, teamwork, commitment, passion, positive attitude, and honesty. So when I'm speaking, I don't remember the flow, but they are very valuable to us, and whenever we find anybody inflecting on those values, we coach them, otherwise exit them. These are the three strategic enablers for our company. Many of this information you've seen in the video as well, but we'll go in detail with each of them. You saw on the video about our TV channel, website, all the different omni-channel platforms that are visible to our customer. Our vertical integrated supply chain is our huge moat that other people can't copy, and that affords very high margin for us. our very wide product bouquet, that is jewelry and lifestyle products, and our in-house brand and innovation mechanism. I'll go one by one with each of them. So this is the omnichannel strategy that we have. And you'll see the TV broadcast on the left and digital platforms on the right. So we broadcast our signal on all TV platforms, cables, satellites, telcos, antenna, and even OTT. OTT has two portions. One is linear, like television, other is app. And digital platforms. Our own websites, US, UK, Germany, mobile apps, the third-party marketplaces, Walmart, eBay, Amazon, social platforms, and OTT platforms. OTT is connected television. So we are everywhere our customer is, and we are able to serve her, whether she's on television or a website or marketplaces or on OTT. We are into one of the three largest markets in the world, largest consumer markets, highly competitive markets, and we have seen growth. We have demonstrated growth in all two markets already, and third, you will see how much we've grown so far, and we will continue to grow in that direction. Our customer segment is Gen X, which is 45 up, and baby boomers, which is 65 up. That segment is increasing day by day because people are living longer, they have time on their hands, and their disposable income, because the children are mostly gone, they're empty nesters. Our price point is $25 to $45 compared to our competitors who are $55, $60. So we are seen as a value segment, and that positioning is very difficult to compete because of our vertical segment, vertical business model. Our product category, we have 25,000 unique designs of the product at any given time. It ranges between 25 and 30,000. From including children SKU, it is about 75 unique SKUs. And we air about 100 new products every day in our business. This again, the product segment, the jewelry segment is 14 to 15,000 new jewelry launched every year. It's mostly fashion jewelry. In-house testing lab and manufacturing. In India, we have about 3,000 employees. In China, we have about 70. Thailand, Indonesia, about 20 each. And we are going to start in Vietnam pretty soon. Lifestyle products, we have unique 5,000 unique styles in our warehouse and selling to our customers every day. And we source our product from 30 different countries from all over the world. We have vertical integrated supply chain, as you saw in the video. We manufacture in India and China. China, we have only about 60 people, it's a small setup, but largely it's outsourced. So we product source mostly LSP products from third parties. And we source in Asian currencies and we sell in Western currencies in dollar, pound, or euros. So this model allows us at 60% margin consistently year after year, quarter after quarter. As I mentioned earlier, we are sourcing from 30 different countries. Our supply chain is pretty robust, mostly out of Asia. And they do all the connections with different countries and organize the products for our supply, for our deliveries. All this business model has resulted in tremendous shareholder value. When you look at revenue or EBITDA or on PBT or net worth, all have grown double digits year after year, 5 year, 10 year, 20 year, 25 years. This is rupees terms. Even if you look in dollar or in pound terms, which Vineet and Shrikant are going to present in their local currencies, the growth has been double digit year over year. Now, this does not include, network doesn't include the dividends that we have given over the years. Now, since we went IPO, we've increased market cap by 270 times since we went public. Now I will give it to Vineet to take us to Austin, Texas.
US.
Studios. This is our live studio where we're broadcasting 24/7. Let's go take a look inside. Okay, so you're going to see all of our different sets in here, but let's see who works the magic behind the scenes. Take a look in here. Right here is where our producer will sit. He is in charge of the entire show. And then we have our director making sure that the show looks perfect when it comes out to you on your television screen. This is our lifestyle set. So everything from fashion to beauty to handbags, we've got it all. And we broadcast live from this set for everything lifestyle. This is our brand new set. We have not even premiered it yet. We're going to go live on this set for the first time here at Shop LC on April 6th. Isn't it beautiful? Right there, we're live right now. 24/7. You can tune in and hang out with us here at Shop LC.
Now this Dave's going to show you about our warehouse.
This is where all of our products come in, get QC'd, and eventually go into our picking robotics area. This is the area where our receiving team actually puts the inventory into the robotics that will later be pulled for our studio or for our customers. This is where our customer orders are picked via the robotic system. Each of our pickers has anywhere from 5 to 7 robots currently helping pick the products for our customers. At any given time, each picker is picking 17 customer orders. The employee is able to do this without ever having to step away from the workstation. Completed orders, once picked, are brought to our packing area where every single piece the customer orders is inspected, packaged to make sure that it will arrive intact, and shipped out on one of our carrier trucks.
After the work.
Thank you, Benit. Hey, welcome to Austin, Texas, and Shop LC, where we broadcast 24/7, 365. So obviously there's a live show going on right now, and I'd love to take a minute to show you what we do here. Let's go on in. Shop and Heather are live right now doing their show. They're selling gold and gemstones, and we're going to go ahead and give you a bird's eye view of what the hosts see when they're selling. This is all the information running from them. That's it. There are no scripts. There's nothing written for them. They are on their own. We have 5 cameras that we switch between for our live shows, and then 5 studios. This studio is brand new. It's going to launch tomorrow for our beauty show. It's the first beauty set that we've built. Gorgeous. It's very exciting. Come on over here. Over here, we have another studio that we sell beauty products from, and we do accessories over here. We have this entire space where we do accessories. This is where our models will model the accessories. And again, we have the TVs, we turn the cameras around, we have the information for the host to see. They see the callers that are coming in, they call out their names if pertinent, and they get all of their minute by minute, second by second update, all real time. And again, 24/7, 365. We're never closed, never break. So let's go into the control room. I want to share with you 2 people. Well, there's 3. There's also a visual stylist. There she is over there. This is the gal who sets up all the product, lays it out, preps it, a huge team. And then we have our director and our producer, right? This is Daniel. He is the producer of this show. So he is keeping track of how long we spend on each item and dollars per minute. Is the item selling? We're not going to stand the item if it's not selling. So he has all these tools here to be able to tell, how he's selling the item. Should he move? Should he go? Right here is dollars per minute. This is a great tool. That's how we decide whether we're going to stay or leave. Okay? So he also has all the callers' names. He makes the decisions in this room. And this is Laura. Laura is our director. She is switching the show. Like I said before, she has 5 cameras, and she switches in between each camera. Now, the one, she's got preview, she's got a beauty shot, and she's got a live shot. Also, she's got content, a ton of content. And by the way, I am director of video content. It's important for me that they use the content. she has many different things to choose from as far as making kind of engaging, entertaining show. So with that, Austin, Texas, live, guys, and thank you very much for having us here.
Hey, thank you, Heather. Thank you for the US. Let's give 10 more seconds to Prashant while he shifts the screen. Okay, here we go. So, like Sunil was mentioning, if you look a span of like FY17 to FY22, we see a growth every year in Shop LC US. In fact, the 5-year CAGR growth till FY22 is 11.8%. Both TV and digital have grown. So TV CAGR is 6.8%, and all these are in dollar terms. So no rupee conversion happening here without here. So a strong double-digit CAGR growth in the last 5 years. So while TV is growing, the digital continues to grow faster, giving a CAGR growth of 24.3% in the last 5 years. Now FY21 saw a blip up. That was because of the tailwind in COVID. We are a digital company selling at home, selling to people sitting at home, so we got benefit in that year. FY22 and now FY23, we have certain headwinds because of people moving out as well as because of all the inflationary scenarios in the Western countries. But when you look at a span of 5-year block, 10-year block, you will see a consistent growth across all the geographies around the globe. The right side, the PBT chart again shows our operating leverage story. So from a 1 million profit in FY17, we are up to 21 million. In FY21, we were 25. FY22, 21 million profit. So with growth of revenue, a good part of that flows down to the bottom line. This is because a large part of the P&L is below the gross margins are fixed cost. So fixed or semi-variable, as you may call it. So larger the revenue and the gross margin being constant at around 60%, which is our guardrail, a good part flows down to the bottom line, and hence the increase in the PBT across last many years can be seen. So we are consistently gaining market share in US. So we were at 1.1%. At the bottom green line shows our US market share. In FY16, we are 1.1%. We are right now at 2.8%. Consistently gaining. So within the earlier slide we saw FY21 was tailwind, now it is headwind, but be it headwind or tailwind, we continue to gain share. So whatever might be the macroeconomic scenario, we are gaining market share, which gives us a lot of satisfaction that we are doing the right thing in the market. So the biggest, now just maybe a line on this. So the market share is being computed not considering Amazon's eBay of the world, but it's basically home shopping companies like us. And the data are published for 2 of the listed companies, so we have considered the 2 listed companies for whom the data is regularly published, and we compare the market share with the 3 companies. So we have consistently gained that and are taking the market share from the leaders out there. Okay, a busy slide, I'll take you through that. So the left part, the left side of the slide shows the cord cutting phenomena, as we all understand. So there is a cord cutting happening in cable. People are moving out of cable. But this plot shows our customer segment, which, as Sunil mentioned, is above 50 years of age. So 50, 64 and 65 plus. So within our customer segment of TV, the cord cutting is happening at a much lower rate. So this is 2015 and 21. So 80% were watching TV over cable in 2015. Now it is down to 66. So some cord cutting happening, but at a much lower pace within our target segment. The middle block shows the OTA homes. So while people are cutting cords and moving out of cable, they are not just moving on to OTT live streams here, but there is something called OTA also, which is over the air antenna, free view. Customer doesn't pay, they get about hundreds of channels which is free to view. And this is growing at a very rapid rate. So in year 2000 in US, there were 13 million OTA households. And in 22, it is up by up to 22 million. So it is growing at a rate of 3 to 4% per annum. So this is growing, this is degrowing, but at much lower pace in our customer segment, and this is growing. And actually, we started playing this game a few years back only. So in 2013, we were virtually not present in OTA. And now we are at 17 million homes. Within OTA also, there are 2 types of OTA, low power and high power. While we have covered substantially a good number of the low power households, 48, 17 million, in full power we are still only 20% penetrated. So what this slide shows is definitely, in spite or despite the cord cutting, we have a huge runway of TV in front of us, opportunity in front of us. One, within cable also, it has a long life because of our customer segment moving away at a gradual pace, and at the same time OTA growing, and we are also playing the catch-up game there. So the right side was the same TV growth CAGR, which we saw about close to 7% in the last 5 years. Now we are very confident of the trajectory going forward within TV as well. Moving on to OTT, again a very busy slide, so let me navigate you through this. So the left side of the slide basically shows the potential growth of all the connected devices. So smartphones, smart TVs, laptops, digital laptops, streaming nodes, and so on and so forth. There is an exponential growth of connected devices happening already, and the rate of growth is only expected to increase in future. So by 2026, if we pick up only one line out of this, say for smart TV, so today it will be there like 100 million devices there. By 2026, it is expected to cross to 74 million. So that is the kind of an exponential growth projected in various connected devices, over which people will be consuming various kind of content. And what is projected is by 2026 there will be 1.1 billion people who are connected devices, not people, in US. So basically every individual in US will be there having at least 3 connected devices. What we are doing in that is we are already present in all the prominent OTT apps, so we Roku, Wait, Amazon, Wait, Fire TV. And we are also there in all the connected TVs, all the prominent major connected TVs. So we are there in LG, we are there in Samsung, we are there in Google TV, so whatever TV supports the Google TV platform, so we are there. So we started investing in OTA about 2 years back. So if you see the revenue in FY20, the right side is the OTT revenue chart for Shop LC US. So we were very nascent, 1 billion of revenue. And FY22, we were already at close to 6 million. So we are investing in this category quite heavily. So John McDevitt, who is like a veteran from QVC, is leading this initiative for us. So we continue to see a very, very rapid growth out there, and we are also projecting a kind of a 40% CAGR growth in the next 4 years, backed by this phenomenal growth happening in the connected devices. Last but definitely not the least, digital. We saw that digital is definitely growing at a much, much faster pace. So 20% CAGR in the last 5 years. We have been investing in digital quite heavily in the last many years. So last year we upgraded our US website from SAP Hybris to Salesforce, which is one of the best in the market out there. Right now we are in the process of moving out our Salesforce Marketing Cloud, making live our Salesforce Marketing Cloud and Service Clouds as well. So all the various touch points of customer, be it promotion, be it CRM, and the website itself will be all within Salesforce in maybe a month's time from now. We are strengthening our talent pipeline continuously, so we are hiring people in Southeastern European countries, Ukraine, Bolivia, and so on, and rapidly strengthening our talent pipeline of digital. And we are accelerating our digital paid campaigns, so we are there in Facebook, we are there in Google, and all the prominent social apps. We are focusing, and we have like right now contracted with a big agency in US, both for our customer rate optimization as well as search engine optimization, and that's also expected to give us good benefit out in future. We went live with live streaming, so our TV was always live, but the social live streaming also we went live about 3 months back, and we are expanding it quite rapidly, and we are also expanding our affiliate network. So e-com is actually complementing our TV segment, but at the same time outpacing TV growth, and we expect that trend to continue in future as well. And at maybe a few years down the line, it will cross TV in terms of the overall revenue. So that's all from Shop LC US. I'll hand it over to Shrikant to take you through UK.
With the financial data, when you look at last 6 years data, CAGR has been about 18.3% overall, Similar to what Vineet mentioned on TV's digital growth has been higher than the TV growth. Our TV growth has been about 16%, digital has been about 26.6% in last 6 years. Similar story on profit side. So in 2017, our profit was £1.2 million, which with the increase of revenue, we saw the leverage and it went up to 11.4 million at the top of the COVID period. In the last 2 years, we've seen some softness, mainly because of the headwinds that we are seeing after COVID and also recently because of the global slowdown that has happened overall. Now, again, this gives you the idea of the market share. So this green line is the TJC market share. In 2017, our market share was 4.8%, which has gone up to now 10.3%. And what we do is we compare ourselves with 3 other competitors in the UK who are from TV shopping. These are, and all the data is all public. There's Company House in UK where you have to publish your data at the end of the year. So these are 3 of the large competitors, and if you see all the market share gain that has happened is mostly taking from the top 2 competitors that we have. And I'll talk more about why we've taken market share from them when I talk about the lifestyle category expansion in UK. So I have a slide about that. This is an update on the Channel 22 acquisition that we did. So you saw that in the video, intro video that we showed earlier. Freeview channel. Freeview is the free TV in UK, similar to what Vineet mentioned, OTA in US. So in the early 80s and 90s, what used to be there in India, the antennas, they are very common in UK. And Freeview actually came in UK in 2003, 2004, and now almost all the household has Freeview TV, about 27 million households. And there are about 90 channels, major channels in Freeview, and the viewership depends upon your channel positioning. Earlier our channel position was 50, and we've moved the channel position to 22 last year in the month of January. Since then, what happened, if you see, this is right before, a quarter before we made the acquisition or moved the channel. Our customer acquisition number, because of the after COVID impact, was declining, and it was declining at a double-digit rate. We made the investment. After that, following 2 quarters, we had increasing trend, so 17% growth over previous year and 36% growth over previous year. This quarter would have been similar, but we had some impact because of the cyber attack that happened in the month of November, and also because of the disruption in UK market. If you are aware of what happened in UK in the month of December, there were actually part of November and most of December, there were lots of strikes that happened in many of the government areas, and one of the most impacted was Royal Mail, who we used for our package delivery to customers. So what we did was we did move our package to other carriers, but they still had a lot of problems. So there is a carrier called Every, and we moved about 70% of the packages to them, and so did many of the other retailers. And so Every also had a lot of unplanned volume that they had to take, and they also had disruption. So overall that impacted customer confidence in online businesses during that time, and customer went to high street to buy. So we had less customer acquisition during that time. But overall, if you see, the investment that we made is paying off. We're seeing much higher customer acquisition numbers, and we are very confident that we will continue to see the trend in the coming months and years. Now this last slide that I have is about the lifestyle category that I mentioned when I talked about the market share growth. We've doubled our market share in the UK, taking mostly from the top 2 competitors and mostly the lifestyle category. And if you see what we've done since 2017, so in 2017, lifestyle category contributed for 19% of our business. This year it is already 49%. Actually, recent months it is even higher than 50%. So we are seeing our lifestyle category grow, and we hope that we will continue to grow at the same pace and we will continue to gain market share. So these are some of the things that it is helping lifestyle category, although it is already at 50% now, above 50% in recent months. It is helping us to expand our reach because people, if they are looking for something other than jewelry, we are now also catering to them. It is also helping us get the growth from the same customers. We are getting the larger share of their wallet. And also it has helped us launch another business which is called TJC Beauty. So we've launched a channel about a couple of years back. It is not full blown channel right now, not 24/7. It's only 8 hours and it is mostly on the Sky platform, not on Freeview all the time. And it is giving us good, decent growth year over year or even month after month. And we expect that it will become a business, sustainable business itself in the coming years. So lots of potential in lifestyle, and as I mentioned, about 40% CAGR in the last 6 years. And we're confident that it will continue to be in that trend. With that, I'll pass on to Deepak for Germany.
Alright, so to start with the German operation, I mean, you saw some information on the video itself. So when we talk about Germany, our first goal was to get the reach. Germany has a huge potential, 42 million homes. So around 42 million homes. And I can announce that now we have a reach of almost 90%. So the penetration is already at 90%. In March, we partnered with Vodafone that gave us around 13 million homes, so added a lot into the number of homes. And Vodafone actually gives us a unique opportunity. It has a very good customer base, people with a lot of money. So that's the customer base that we have recently added. If we talk about the revenue, so our revenue is growing well, around 1.4 billion rate. This is the last quarter numbers, with a healthy margin of 60%. And margin is down to the strong supply chain that we have, and that's the uniqueness that we have in Germany. The price point that we are operating at, our average price point, no competitor is there, so competition is very less in that price point. And also with jewelry and lifestyle that we have entered, we are acquiring a lot of customers. Now, this is a trend of revenue, so you can see here. So this is the trend. So we started the business in financial year 2022 Q2, and there has been a steady and rapid growth in the revenue. So this is the revenue for last quarter, where we did around 4.3 million in overall net revenue. Our digital contribution is pretty strong at 31%, so that's another positive. So a lot of customers who are coming to us, they are not only just shopping on television, but a lot of them are also transferring to the e-com platform. The other thing that we see, which is very healthy and unique to German business, is a very repeat purchase. So around 70 pieces is what a particular customer is buying. So this is very healthy, considering that majority of our customer base is pretty new. When we talk about their retention, so how many customers come back to us after a year, we are seeing pretty healthy retention of around 40%. And even the customer satisfaction score is around 96%. So what we have seen is a very loyal customer base, and the best thing about German customer is they are conservative, but when they put their trust on you, they stay with you. So that's the very positive side. Here on the bottom part, you can actually see how the customer trend is shaping up. Point is on. So yeah, towards the bottom you will see, so if you look at our overall customer pool, now it is already at 52,000 customers, and it is growing rapidly. Especially with Vodafone coming in, we expect the overall pool to jump rapidly. And this is our presence in Germany, so overall now, all the major networks we are there. And especially on satellite, there are around 20 million homes where we have 2 channel positions. So that actually helps in the discovery. So that's all on the Germany, and I'm sure there will be questions, so I'm waiting. Thank you.
Performance. As you have seen already, that all the our 3 retail territory has shown the growth in their local currency terms. But if we see in rupees crore terms, our revenue for past 5 years has grown consistently. In CAGR terms, it is 13.9% in past 5 years. revenue grown from 1571 crore rupees to 2752 crores. However, this year in 9 months so far, we haven't seen the performance what we had expected. But if you see the performance pre-COVID level, we have a growth of 34%, which is almost around 11% CAGR. And if you see the sales from major two platforms, TV and web, both of the platforms are growing consistently. The TV growth is 11% CAGR in last 5 years, but web has outperformed our TV performance and grown 29% CAGR over 5 years. This year, both of the platforms is around in 9-month performance 3% down compared to the same period 9 months. But pre-COVID level, both per platform is growing. TV is 27% and web is 56%. Moving towards the other financial numbers, margin side, as we have seen, the vertical integrated supply chain has given a strong margin of over 60%, and consistently we are seeing over the years. In first 9 months of the year, our margin is a healthy margin of 61%. However, we see a pressure on PAT and EBITDA margin in past some quarters. Basically, it's related to the new Germany operational losses and our operating deleverage. But there is a silver line. In recent terms, our initiatives related to cost rebates and Germany narrowing down Germany losses, and our better pricing is improving our EBITDA margin from 6.9% to again double-digit margin of 10.5% in last quarter. Moving towards the net debt position of the company. So company is generating a healthy cash, and company maintaining continuously last 5 years a negative net debt, and in the first 9 months our negative net debt was 118 crore rupees. Company's net asset in FY22 is 540 crores, and in first 9 months is 590 crores. Company is a very asset-light model, and they give a leverage to invest in the future opportunities. Financial 22, we have seen and we have invested a lot of amount in our US headquarters, Robotics, as you have seen, mobile apps and our smart TV apps, and the channel 22 we bought in UK. That was the year of investment that we did. And moving towards our free cash flow. So company has seen this free cash flow shows the robustness of the business model. You can see that last year we have 214 crores negative free cash flow, even though we had a higher profit. That amount of profit we have invested in our future growth. And we have shown this year the agility to improve it to 96 crores free cash flow, even though we have a lower amount of profitability. And in terms of ROC is a healthy trend. It was improving past 4 years and increased the highest to 61%. Last year, as we have seen the headwinds related to COVID, and they were reduced to 31%, and first 9 months it was 15%. Now I'll hand over to Steve.
The digital business in UK, as a percentage of total sales, this retail, has gone down in 2022 compared to earlier COVID years of very high digital penetration. So from 19% in 2019, this is calendar year, and 2020 it was 27%. So sorry, yeah, this financial calendar. And in 2021, the top of the COVID period is 30.9%, and 22 it was 26%. In US, it has gone down slightly as a percentage of retail sales. It is not as high as UK, but from COVID high of 14.8 is down to 14.5 as a percentage of overall retail sales. There are broader macro uncertainties amidst war happening in Europe, cost of living crisis in UK, UK delivery disruption that Srikanth spoke about, and industry-wide year-over decline in online marketplaces. online digital space. So this is the current business environment as we are operating in, and that impacted our performance in current financial year and a little bit into last financial year. But as Vineet and Shrikant shared, it is also that Nitin shared, compared to pre-COVID year, our CAGR is still very healthy. Way forward, where do we see our business drivers coming in? One area we are looking at is digital. As Nitin mentioned, we already invested in tech infrastructure. We invested in digital marketing. In earlier quarters, you might have seen our investment into digital marketing gone up. Social influencer marketing, video commerce that Vineet spoke about, OTT, that is the connected TV that Vineet spoke about. So current revenue mix in digital is 37%. In FY26, we expect it to go to 50%. Now, last 5 years CAGR for entire business is at 29% of digital growth that you see. The other driver is product mix. We expect our lifestyle category to accelerate more than jewelry. So this is a natural extension to fashion jewelry. Our customer trusts us. When the customer trusts us with jewelry, it will be easier to get them for house product or apparel or fashion or beauty products. And we have opportunity to cross-sell. We get larger wallet share of their customer. And our sourcing base is across the globe. We can leverage that sourcing base to acquire more and more product and get larger wallet share of the customer who's trusting us. So current revenue mix of LSP, lifestyle products, is 28%, and we expect it to get to 50%. Now UK is already at 50%. US is much smaller, but US is larger portion. That's why we're taking a little bit conservative target for FY28 to get to 50%. As you will see, the 42% CAGR over 5 years of our lifestyle growth. So this is a good. The digital business in UK, as a percentage of total sales, this retail, has gone down in 2022 compared to earlier COVID years of very high digital penetration. So from 19% in 2019, this is calendar year, and 2020 it was 27%. So sorry, yeah, this financial year calendar. And in 2021, the top of the COVID period is 30.9%, and 22 it was 26%. In US, it has gone down slightly as a percentage of retail sales. It is not as high as UK, but from COVID high of 14.8 is down to 14.5 as a percentage of overall retail sales. There are broader macro uncertainties amidst war happening in Europe, cost of living crisis in UK, UK delivery disruption that Shrikant spoke about, and industry-wide year-over decline in online marketplaces, online digital space. So this is the current business environment as we are operating in, and that impacted our performance in current financial year and a little bit into last financial year. But as Vineet and Shrikant shared, it is also that Nitin shared, compared to pre-COVID year, our CAGR is still very healthy. Way forward, where do we see our business drivers coming in? One area we are looking at is digital. As Nitin mentioned, we already invested in tech infrastructure. We invested in digital marketing. In earlier quarters, you might have seen our investment into digital marketing gone up. Social influencer marketing, video commerce that Vineet spoke about, OTT, that is the connected TV that Vineet spoke about. So current revenue mix in digital is 37%. In FY26, we expect it to go to 50%. Now, last 5 years CAGR for entire business is at 29% of digital growth that you see. The other driver is product mix. We expect our lifestyle category to accelerate more than jewelry. So this is a natural extension to fashion jewelry. Our customer trusts us. When the customer trusts us with jewelry, it will be easier to get them for house product or apparel or fashion or beauty products. And we have opportunity to cross-sell. We get larger wallet share of their customer. And our sourcing base is across the globe. We can leverage that sourcing base to acquire more and more product and get larger wallet share of the customer who's trusting us. So current revenue mix of LSP, lifestyle products, is 28%, and we expect it to get to 50%. Now UK is already at 50%. US is much smaller, but US is larger portion. That's why we've taken a little bit conservative target for FY28 to get to 50%. As you will see, the 42% CAGR over 5 years of our lifestyle growth. So this is a good revenue driver for us. Now we have 4 R principles: registrations, reach, registration, retention, and repeat purchase. And this we constantly track internally, and we also share the number with investment community as well. Our reach, we continue to increase as Vineet mentioned in OTA, OTT, and through digital, as Vineet also mentioned, and Shrikant alluded to it. We are constantly increasing our reach. Within TV segment, it is 142 million already, and we have much more potential to grow within US in OTA. Some more cable in UK, maybe more number of households, number of channels in the same household. In Germany, some more, and Austria quite a bit. Same feed goes into Austria as well. More registrations means new customer acquisition. So give us product portfolio, better value proposition, because our average price point is lower than our competitor, and also with engaging content. As you saw, our content is pretty engaging. As we make it more and more engaging with our vertical model, we can take customers to Bali, to India, to Brazil, to Turkey. We do that all the time. That engages our customer better than any other retailers in this space. The other retailers, Walmart or eBay, they can't take consumer direct to those places because us being vertical is much easier and thus at better cost effectiveness. Better retention because of our relationship, our engaging content, and convenience, digitization, us being in every place wherever the customer goes. If she cuts the cord on cable, we can get her on OTT or on antenna or on marketplaces. And repeat purchase. Cross-selling, expanding market share through multiple product offering, we can increase repeat purchase. So these 4 are major drivers for our business, has been for many years and will continue to be so for many coming years. Strengthening our own brand portfolio. Our current current brand contribution is about 30%. Internal brands as well as external brands. We expect this brand portfolio to increase to 50% by FY27. So when we have brands, people's engagement with the brand is very high. For example, we have some great jewelry brands in Ileana, Rhapsody, and Luxoro. And then in high-end jewelry, high-end bags, we have the Bell, Grand Bell, which we offer exotic skins like genuine python, genuine crocodile, genuine ostrich, Symphony, very high-end sleepwear, silk pillow covers, silk sheets, silk bathrobes, silk scarves, and they do very well for us. And La Mere is also a good brand that people have affinity with. So increasing brand, we've seen customer lifetime value is higher when we move them into brands. ESG, we have very high focus on ESG, and I will invite Pushpendra to talk about ESG initiatives.
Thank you, sir. So ESG, as you see, sustainability initiatives, we have plenty of them actually. One of them is energy, that is the electricity that we use. We have solar energy, solar plant installed at Beacon Hill, which is our own plant, and it is the capacity is around 3.23 megawatts. This plant is fulfilling 100% power requirement at our manufacturing units in Jaipur. We have got EVs, which are basically electric vehicles.
Corporate governance and transparency to our stakeholders. So we have a very diverse and professional board and expert in their own fields. And company stated that our dividend policy of 20 to 30% of our free cash flow. And company had paid last 12 quarters continued dividend. And around this year so far 74 crores dividend paid. Company's credit rating is one of the highest in the industry. And with the many awards that we have won, including the CSR and corporate governance award from the Company Secretary of India. And company, pretty much all of the units of the AffordableRobotic Limited is great place to work satisfied.
I'll take it back from here, just one slide. So, as Sunil mentioned, we have a team of highly committed, passionate people who have come together for the mission of 1 million meals per day. It is not any revenue generating mission that way, but then we have got lots of training and development programs for all our employees. As you can see, at the entry level, which means the worker level and above that, we have got around minimum 30 hours per year of specific training to that person. It is not just a general training given to everyone. Specific training to each of the employees, and it is kind of identified through various processes in appraisal or the monthly one-to-one meetings that they have with their supervisors. At the leadership level, this year the target is around 100 plus hours per year. And as you can see, there is this career pathing. It is not simply promotions. When we say career pathing, this includes people who have got passion to do something else. What they were doing, say, they could be, I'll give you examples, they could be just a driver in the company, and they could come to me and say, I want to be in HR. So we provide them training free of cost, and now he is the recruiting executive in regional. There is a pantry guy who used to serve tea. He wanted to become a setting worker, and he was given training, and he was best worker for 3 consecutive months at one point of time. So this is the way that different employees with different passion can change the departments. And we have around 254 white-collar employees this year. This was only this year that we transferred. And upskilling and mentorship program, all of these great leaders here, they are mentors also to the employees. We have got 20 mentors, and 50 mentees are currently being mentored, and around 1,000, each of the mentors have spent around 20-25 hours every month, every year. So that is the way they take care of the mentees. So there is this, the mentees will come with their strength, weakness, opportunity, threat, WOT, and then the mentors will chalk put a goal plan for them and provide them training. Please pardon my throat, it is having some problem. And then we, as we said, great place to work, certifications in India, US, UK and China. You would be wondering why not Germany? Only because the survey for Germany started this year only, and I'm pretty sure that we'll be there as a great place to work again. So you can see some of the snippets here of the way we train, and we have an innovation team which is continuously innovating new products and processes, and of course planting. So I think now go back to Sunil. Thank you.
So, summary of the conversation today. So, VGL today is a virtuous flywheel with many diverse forces working on the flywheel itself. We have very high customer orientation. We have high CSAT score. As Deepak had mentioned, German, such a new operation, we already have 96% plus CSAT score. Similar is in US and UK as well. We conduct Net Promoter Score survey every year, and that is very robust as well. Although in UK, we took a beating because of deliveries last year. Other than that, we did very well, both in US and UK. We have very high employee engagement. As you saw, all our units are Great Place to Work certified. It is not easy criteria to get to Great Place to Work. It took us quite a long time to get to certification. Indian unit last year was one of the top 50 companies in India, 50 manufacturing companies in India for certification. So this goal we had discussed many years ago, but it was quite tough to achieve. We have 3,000 employees in India. Great Place to Work surveys all of them for technical side as well as for management, so what we call culture. So both sides put together, we were certified around the top 50 companies manufacturing sector in India. Continue giving back to communities. Pushpendra shared, we are consistently giving back to community in terms of children's meal as well as environment. That in turn connects with our customers, our employees. For our employees, it's just not a job anymore. It's an objective, it's a passion, it's a purpose. And that connection fuels itself. It's a flywheel, it's a virtuous flywheel. Consistent progress, as I spoke about, environment and shareholders. Nitin mentioned that we've given quarterly dividend last 12 quarters consistently. And as you saw, our stock price has grown over many years. That is not in our hands, that is in your hands. But since we've been working consistent delivering, and we have been rewarded consistently by yourselves. So as you see, all these forces put together creates a positive force for VGL to continue to move forward and give consistent benefit to all stakeholders, whether it's customers, employees, investors, or communities, and environment. Thank you.
Just a small reminder, let us not ask any questions pertaining to the current quarter, which is Q4, and the full year of FY23. Thank you. We have the microphone.
Bringing the top management, as well as the peek into the US operations. It would be nice to have a peek into the UK and the German operations as well, in terms of the studio. But perhaps, that's for the next time. My question is regarding the change that has occurred, and you have attempted in your presentation to address this concern that there is cord cutting, there is this transition where people are not watching as much TV, and their attention is now divided across multiple formats and channels, etc. Now, pursuant to that, you had started spending a portion of your revenue towards making yourself present and on all these formats. That is part one, and the part two was making your presence felt so that people can identify you on those new formats and start engaging with you. Because earlier life was easy when you were dealing with television. Now it is divided across multiple screens, multiple channels. So my question is that how long would this extraordinary expenditure continue? And when do we see a return to a kind of a more modest SG&A, which was a simple formula for us that, okay, Vaibhav does not go below 60% gross margin, so, and price changes are not very easy to make. So it is volume growth at the top, and from there you deduct the other expenses, and so you could get a fair idea about operating leverage. We saw that. Last few, like 8-9 quarters or slightly longer, that arrangement has broken down somewhat. So if you could elucidate what is the current status and where do we go from here, such that we can arrive at a point where it becomes, a modest increase in SG&A, which allows us to project in a more confident manner.
Thank you, Anil. Thanks for your compliment, and thanks for following VGL for a long time. I always appreciate your very intelligent questions. So your point about getting the leverage back, and how about and whether we can moderate the investments. So last 8 quarters, as you rightly said, we made a lot of investments, and we termed last almost 7 or 8 quarters as a period of investment for VGL. We made investments in Germany, almost 2 years now. We made investments in digital, OTAs, OTTs, and marketplace. And we believe that investment, Germany will continue for another few quarters. It will become break-even towards the later part of this year. But other than that, we have seen quite a lot of investment behind us. We'll continue to make this money, but continue to make those investments, but the leverage will start to flow in now. As you saw last quarter, there was some leverage. As we mentioned earlier, leverage should start to come in coming quarters and years. When we go back to the top 15% that we achieved 2 years ago, I can't give you exact guidance, but we should get back to those in foreseeable future.
So I have a follow-on question on that, one on the operating leverage and the resultant operating margin, as well as one more. So starting with the operating margin question, one of your competitors has recently changed their name from QVC to something else. They have gross margins which are materially lower than yours, but yet they have operating margins which are much higher than yours. I understand it's a question of scale. So how do you visualize, and what kind of revenue do you need to reach such that you can reach a 20% EBITDA margin?
That's very hypothetical, and I can't give that guidance. What I can say is, if you're talking about Q8, they're at much higher scale. They're about $12 billion. And $12 billion, they reach somewhere between 15 to 20% EBITDA. But the gross margin is very low, as you rightly said. They are in 30s or high 30s in gross margin compared to our 60s. And their business model is different. They are into branded products. They are like Samsung or Bose or national brands. We are into our own brand, somewhat like Inditex, Zara. So their own brand, they are at 55% gross margin, and their EBITDA is around 20%. So we believe that we can reach between 15 to 20% EBITDA to be much lower, even below a billion. I can't give you exact numbers, but we'll reach there between 15 to 20 billion, 15 to 20%, closer to 20% below $1 billion.
Thank you. And my last question was, for the past 4 or 5 quarters, there has been continuous reduction in the EBITDA figure when we compare it with the comparable quarter previous year. I am not seeking a guidance from you, but when do you see that this trend of negative growth in the EBITDA level, when do you see it ending?
Last quarter you already saw that.
No, I would remove the other income and then we talk.
For us, other income is part of the business today, except the foreign exchange. Because other income also has, we give the shipping coupon to the customer. What they pay for the shipping coupon is part of other income. We get cash back through credit card processing. There's a large portion of other income. So other income is part of the business. It's not really one-time kind of. You see it every quarter coming. Okay. Largely. except the exchange gain. This is a small portion. Thank you very much.
Sir, it is very heartwarming to see a 100% Indian MNC which manufactures in India but sells in US, UK, Europe, Germany. Of course, you will extend it to entire Europe. As well as you have put up one manufacturing center, rather you made it very clear that it is having 60 people in China who are sourcing whatever we need from China in the best possible manner. So it is full marks to your incisive and in-depth globalization concept translated practically into top line and bottom line. Now, since you are globally so very widespread in US, UK, Germany, as well as sourcing from China, entire globe is facing three dinosaurs. One is the Russia-Ukraine war, which has brought the first dinosaur of inflation through food and fuel. Second, to combat inflation, the antidote adopted worldwide is rate increases, which are happening in the US, India, and all. And the third is, you never know when there will be a return to stable economic, socio-economic growth and living. And your comments on three disturbances which globally we are facing. Personally, I am seeing Russia-Ukraine war as a proxy of a World War III. Because behind Ukraine is Europe and US.
Thank you very much for your compliments and thanks for your questions. I'm not really, capable to forecast or hazard a guess on macroeconomic or the world politics. So it is what it is. What has impacted is a very good point. So it's impacted two ways. One is the trade cost. It went through the roof.
Yes.
And other is the interest cost.
Yes.
So inflation fees as a result. So I'll answer the shipping cost. So shipping did impact us, and that did impact in terms of delays of the shipment product coming in. And that impacted our sales. So that did, but that is behind us. Now, as far as the cost was concerned about the shipping cost going up, we could increase that to our customers. Because we bring 100 new products every day, we could quickly pivot into different products. We could bring, say, for example, a bed sheet of set of 6. We change it to filled bed sheets or printed bed sheets. We change it and increase the value. It was very easy for us to incorporate the cost increase. Commodity price increase also we could incorporate. We saw gross margin to be same. Our inventory didn't go up substantially. Dollar terms, in fact, last quarter was lower compared to the year before. So we could manage the inventory, we could manage the cost very well. Now, next point was interest. Now, this is true, and you saw the impact of interest in both US and UK. You saw the 9-month numbers, they were lower year over year. And that is the macro headwind we are facing. But we believe that whoever is the retailer, we can handle better than anybody else.
Excellent. This is brilliant.
Because reality is reality. We can't negate the reality. We can handle better than anybody else. And you see there our confidence. Because we are still investing. We are paying dividend as we are usually paying. We are investing, we are in front of you, sharing all the numbers. Our disclosures are best disclosures in the industry. All the numbers are best. We are answering every question without coming contra to silly factors. So we are confident about it. We have one more question, Mr. Last question. One more question.
We come back to you. In the thought process it came out. And my other thought was that you are all over the globe, virtually. You are manufacturing and sourcing from India and China, but you are not developed your product selling or your verticals of selling into India and maybe China.
That's a good question. We understand Western markets very well. We've sold to those markets for the last 40 years. Always sold. We never sold anything. We need to understand Indian market. But it's actually good because in India, if you were to retail today, it's still loss making. Retail, e-com retailer or TV retailers are not profitable in India. Customer, nobody wants to pay shipping costs. The credit card penetration is not as good. So still there's a time for the market to mature, and we believe that we will come into India down the road. I don't know when, but it will happen in our life cycle. Life cycle means foreseeable future. It may happen in 5 years, it may happen in 10 years, I do not know. But we believe that we are not ready for India, or India is not ready for us.
Thank you. Yeah, my name is Avinash. So the first, I have a couple of questions. The first is relating to your business model across US, Germany and UK. So you would have had your series of challenges in US market and UK market while you were growing. So what are those challenges specific to German markets and Austrian market? If you can speak up a little bit about this, I will ask the questions once you answer this.
So, coming from US, UK experience, and we were in Germany in 2007, and in GFC, we exited this market. So we understood quite a bit about German market because of our own experience, and we know the demographic is pretty similar. In fact, we are finding the lifetime value to be a little better in Germany than US and UK. So far we haven't found any because of our experience and similar demographics. Not to say that we did not find, we may. So far we are firm on our guidance that we will break even in H2 of this month.
What kind of growth you are looking at the German market maybe 3 years down?
So we can combine growth guidance for the company about 15 to 17% of growth in midterm for entire group. So we are not giving specific guidance to Germany, but given that market is pretty large and we already are distributing pretty much all the market, so we continue to grow pretty rapidly.
So my second question is regarding, you spoke about creating sub-brands. You already said under the mother brand. So what kind of resources you are backing? So it's a different style of selling. Do you want to do some licensing of brands also? And if you're creating sub-brands, what kind of resources you are backing up with?
So we as a company, we have a policy of not selling more than 20% of our revenue of third-party brands. So not more than 20% of our revenue should be ever with third-party brands, because third-party brands are mobile. And our in-house brands are captive brands. And we create those attributes for those brands, respective brands, and create aspirational need in the customer to buy the brand again and again when we drop new products, new collections in those brands. For example, we bring constantly new products, Rachel Galley, or Iliana, Rhapsody, or Luxoro, or Granta, that are aspirational brands. And those brands have seen larger or higher lifetime value. And our aim is to increase that to 50% of our revenue by the financial year 26.
So when you say 50%, you're talking about these brands like Iliana, etc., which the contribution from them going to 50%.
Including outside brands. The outside brand would have some portion of revenue, and inside brand, house brands will have higher proportion of revenue.
One last question, business model related. I want to know the rejections or the returns, how it has moved over the last 6-7 years as a percentage of, maybe you can talk about the volume, the rejections, and is there a different return policy specific to the market, and who do you build the reverse logistics cost to? That's all from my side.
Yeah, that's a very good question you're asking. We are a vertical business, so we don't have any vendor to return the product to. So we have to manage all the returns in-house. Now, your question will be, how do I manage? How do we manage? We have a unique model. Nobody has it. When all those fragmented products come back, or the tails of the 100 new launches we do every day, we put it on automated auction, $1 auction or £1 auction in UK, $1 auction in US. So we are automatically scheduled. And there's a criteria set up. So everything is put on online and people bid against each other. There's no result. Like, eBay. eBay used to have this auction model. We have thousands of products go on auction online. If you go shoppersy.com or tgc.co.uk, you'll see those $1 auction, $1 pound auction. And it sells wherever it sells. People compete against each other and highest one bidder gets it. We close auction within few hours or within a day or within a few days. And a lot of those returns that you mentioned sells through this. If the returns are sellable, if there's quantity enough to take it back out here, we take it back out. But most of the time, it sells either online clearance or just $1 auction. And you would see from our working capital, our inventory as a percentage of revenue is pretty constant. In fact, it has improved over the years. The number of days is lower year-over-year. So we become more efficient in our working capital management. And so, again, I say this is a unique model. Nobody has that I know of to exit that return and get still through this $1 auction. We still don't lose money. We still make some margin. Our 60% margin that we make is inclusive of that low margin that we make on this auction.
So you answered the question of how do you deal with the rejections and returns. So my question specific was the returns and rejections, how they have panned out over the last 7-8 years. 7 साल पहले क्या था, आज क्या था? In terms of efficiency or the customer behavior, how it has changed over the last 7 years.
So US has improved over the years. So US currency is about 70-80%. It used to be about 20-22%. So the customer engagement that we are doing at a personal level is improving this time. We are certifying some product as well. That's also good. UK, on the other hand, is higher because of current economic environment as well. Other than that, UK is about 27-28%. Germany, we are seeing higher returns. It's north of 30% right now. But there is the economics of the market, because in UK, in Germany, when customer returns the product, they will refund the shipping. In UK, we have to refund that shipping that we charged from them. So they have nothing to lose when they return. There's a typicality of the market. And we knew that going into that.
So it's because the competitive landscape is like that, they do it that way, so you have to do it that way?
Yeah, all retailers, all online TV retailers, they refund the shipping cost of that when the customer returns that product.
And in case of US and UK market, the secondary movement, again, the reverse logistics is billed to the customer?
Yes, customer pays for that. Unless it is defective.
Yeah.
If it is defective, we bear the shipping cost. And we send the labels in the shipment. They can use the label. We charge them against the cost of the return, against the refund amount that they would pay back to them. But in case if it is defective and we see it is defective, then we would not charge anything on the return.
Thanks, Mark, and all the best.
Go ahead, go ahead.
I mean, growth of those countries.
Business model. Our business model is compelling. Value is compelling. The storytelling is compelling. The team that we are building is very compelling. The purpose that we have built for the company, delivering joy, and the mission we have around meals is engaging customer and employees. And all the flywheel that I spoke about, all the forces of flywheel are being worked on. There's not just one reason. There are multiple reasons for a business to succeed. We are working on multiple levels for this business to continue to grow.
Yeah, hi. Sir, you said that we operate typically between $25 to $45 piece market. You also shared some market share data and also the market size. But I would presume that the market size that you are showing in the market is the entire market. So if you could give us some sense of the relevant market size for us, because market above $50 would not be something that we would be able to address. That would get us some better insights in terms of what is the addressable market opportunity, what is the type of gain we can have in market share.
So the market share that we address here is only TV shopping / e-com companies in those markets. in US is Curate Group and there is Shop HQ. There's only two. They are listed companies. There are more companies, but we don't have the data on them, so we don't compare here. So we are only dealing in published data. There's two, and in UK there's a QVC, there's a Ideal Shopping, and there's Gemporia. There are three other companies. They are similar business as us. Their average price point is higher, definitely, but addressable market is similar. We also compete against other markets like Walmart or eBay or Amazon, but we don't take that into consideration. So there may be some segment we don't deal in. For example, we don't deal in high-end electronics that QVC does. For example, laptops. We never sell laptops. But we can gain some of the market share from other players like eBay's or other D2C brands. So we believe that $20 billion in US is pretty, 20 billion in all three markets put together is pretty addressable for us.
But sir, for example, in UK, I think it's some 2 billion or something that you mentioned. Since we are not present in above $50, so if the market is like 50% market is above $50, then it's not addressable by us, right? Is that understanding correct?
I don't look at it this way. From television business, people don't come in the morning thinking I need to buy a dress for $100. They don't. They come to for the entertainment, for education, for company, and maybe they'll buy something. Because the programming are not really defined very, very tightly. So once people come in, we can then sell the product to them. We differentiate ourselves. So the price point we have is to project a value perception to the customer, which they would not have otherwise. But in customers' eyes, we are a competitor against Curate Group or JTV or Ideal World. So we don't think to differentiate from that point of view, from the market size point of view.
So consider our market share is like 10-11% in UK and some 1.5-2% in US. Do you see that at least for a very reasonably large amount of time, say next 5 to 10 years, we can have significant market share gains going ahead?
Yeah, so we could if we were to grow like Amazon did in India. There's a buying the customer. But we have certain guardrails around us. I have to answer next time to Anil as well about leverage. So we have to grow profitably. And if you want to grow profitably, you have to be very conscious of what kind of customer you can get. Customer who is friends and family, referral, through online, you have to spend cautiously, not just go blindly and acquire customer. So our approach is more measured and profitable. It is not easy to be growing consistently double digit, profitably, with high margin, with good ROI or good ROC. And it's a balancing act for us. We'll continue to be frugal, aggressive but frugal, and cautious. If I answered your question.
But is there some sort, for example, in UK now that we are 10% market share, normally we see in some of the markets or in some of the other consumer segments that once you reach a threshold of market share, then the gains are much faster. So do you see something like that in any of the geographies for us, either US, UK?
I have not seen that study, so I do not know. If there is such phenomena, I'll be the happiest person.
And in terms of, I can add to this. In UK, if you see, the largest competitor that we have has 64% market share. So one company has already shown that the headroom is there. And second, to your follow-up question that you mentioned about the average price point 50, we do sell products that's above 50. We also sell products that's £1,000, £2,000 product. But our average price point is lower. We also sell a lot of products that's £10 or £5 product or £7 product. So our goal is to stay lower than our competitor average price point and overall product that we sell, so that our value proposition is there. So it's not that we don't sell higher price point products. So the $2 billion market share that you saw is all addressable to us for TJC UK. And so similar for US as well.
And in terms of gross margins, own brands or lifestyle products, do they have better gross margins? And as their share increases, will it have any impact on the overall gross margin of the doctor?
They have slightly better margin, our own brands compared to the outside brand. Slightly better. Not too much of a difference because we don't take any outside brand that will offer us less than 60%. We don't. So that that in a way eliminates Samsungs or Apples for us. They would not come at 60% margin. And we are happy with that because those brands are risky because they can move very quickly and they have more larger leverage than the mid-tier brands or small brands.
So when we move from this 30% in-house spends to 50% by 26 or 27 as you guided, what type of impact it can have on our gross margins over the next 3-4 year period?
So 50% is combined of outside brand and in-house brands. What we believe not in terms of margin, but in terms of repeat purchase. We believe that retention will be higher and repeat purchase will get better.
One question on your EMI scheme, if you could tell us, how does that work and is there any risk that is there also on our books because last couple of years we have seen some increase in terms of the bad debts.
Yeah,
so if you could explain that to us.
Let Nitin talk about it.
Sure. So our EMI normally is we offer up to 5 installments per customers. Based on the cadence we have decided internally about the price, margin of the products. The first of the installment we collect the first place. The rest of it is collect later on within 30 days. So we started around this program in 2016 and we are fairly confident. We have seen a good amount of customer easiness to buy the products. So we have increased around 37 or 39% of the sales, total sales is coming through budget pay program, which is EMI loan. And we, over past years of learning, we haven't seen risk on it. Our bad debts remain 1.5%. UK is much lower, US is 1.5%. But we fairly confident the improvement in sales and margin we see a quite good productive of this program.
So basically the EMI is financed by us till the time. So till the time it is repaid, that risk we carry on our balance sheet.
We finance ourselves, there is no interest cost to the customer.
And considering the current macro environment where there is some challenge on the economic front, do you see in the short term any risk that this default rates on your EMIs could go up?
Yeah, we regularly monitoring this data daily basis. We haven't seen increase in the bad debts rate, and we offer based on the normal monitoring customer cadence. Like we decide that just giving the example that customer giving a limit based on their past spendings. What is the payment behavior in previous cycles what customer had? So we do the analytics and decide the cadence. It gives the more comfort on the financing side.
So just one last question on Germany. If you could give us some sort of a market share aspiration. So for example in UK we achieved double digit. So can we repeat the story of UK and Germany in the next 5 to 7 years?
Difficult to give guidance on that. We only give guidance of mid 15 to 17% growth, revenue growth for midterm.
I think you run a very efficient business. I just wanted to understand what is the total customer base that we would have at this point and what are the additions, cross additions that we are seeing?
Customer base is 500,000 total customers we have.
Trailing 12 months.
Trailing 12 months. Active customers.
What is the addition that we are doing in this?
Every year we acquire around 200,000 customers, including Germany.
So, if I look at, let's say, data about 2 or 3 years ago, our retention ratios were close to about 50%. That number is about 40% now. So, on our 5 lakh base, we end up losing 2.5 to 3 lakh customers, and we end up adding another 2.5 lakh customers. How do we expand the base? Because I mean, this has been a key challenge for Vaibhav for last quite a few years. Could you throw some light on that?
Yeah, so the reach was, in 4 hours, the reach is one of them. To reach the customer through different channels within the same market, like digital marketplaces, OTA, OTTs, and social, and to go to new geographies. So expand that reach of the customer and then retain more customers.
But that doesn't appear to be, because if I look at last 4-5 years of data, I think हमारी 3-4 साल पहले भी कॉन कॉल पे 4-4.5 लाख का नंबर था. Then my notes say another similar number about 2 years ago. Now it's about whatever 4.5 to 5 lakhs. So somehow we are able to just replenish the leakage. And now we have shifted from TV to digital, which is supposedly far more powerful medium. Our region is our business is expanding in UK even more. So what needs to be done to get this customer base moving in a more aggressive manner?
So part of this is the macro environment. Because macro environment, there's a headwind right now. People are not as open to spend the money as they were during pandemic or even before pandemic. So I think all the investment that we made in last 2 years should come to fruition in coming periods. Once the economy kind of get back to business as usual. We expect to see an increase in that.
Another question is around our revenue growth. We've been growing at close to about 14.5% last 3 year or 5 year CAGR. Now, if I take the impact of rupee over a 5 year period, that works out to approximately 22-23%. If I were to adjust this number, would our actual constant currency growth rate be closer to 10-11%? Is that a fair assessment?
So the 5 or 6 year CAGR was given by Vineet in dollar for US and Shrikant for UK. So the US was 11.4%.
11.8 and 18.
But even the blended CAGR in rupees is also close to that.
Yeah, but because the pound devalued from 1.6 to per dollar. So 1.6 dollar to 1 pound, now is 1.15. So pound devalued quite substantially for us. That impacted our, so rupee looks good against dollar, but from pound it didn't.
Also maybe within this period we might have moved away from B2B also. We used to do a lot of B2B earlier. Now we are focusing only on B2C. So the B2C growth rate better off. That also might be impacting. So because we used to do a lot of B2B.
But B2B had become very marginal even I think 3-4 years ago. I mean B2B was substantial prior to that, but 2-3 saal mein that number has been fairly marginal.
It has been impacted slightly in the 5 year CAGR when you look at the group and the UK and US. So besides the currency playing out here.
But majority when you saw the number for US and UK, both had robust numbers.
Another point was, if I look at historical data, between let's say 2017 to about 21, we've had a fantastic run. 1450 crore ka top line became 25-2600 crore ka range. What exactly happened during those 3, 4, 5 years? What caused, because our number of transactions per customers have remained within a range. Has the ticket size gone up substantially because number of customers have again stayed within the range? What happened in terms of our journey over those 4 years?
I don't think it's one factor, there are multiple factors I'm sure. So product offering and the repeat purchase increasing. Customer numbers must have increased. I don't have the data in front of me. I'm sure the customer number must have increased as well. So there are multiple factors of that. And if you track the number of customers and the retention, the repeat purchase, all four areas, you'll get the full picture. We can share the data with you if you want. Prashant can share the data with you. What area impacted what?
And lastly, we have about 10% UK's market share. Our revenues are close to what, 70 million pounds?
80 million.
Yeah, 70-80 million pounds. So total market in UK is about 800 million pounds in the telemarketing space?
Yes.
Yes. 800 million or 2 billion?
It's a 2 billion market size.
Yes.
But it was the addressable that we have shown.
Now, how do you define that?
It is that the direct competitors who publish the data. So like just we'll mention QVC, Ideal World, Temporia. These are the 3 main competitors. There are the small competitors also who are having 10 million. We don't compare that. But having those customers, there are around 20 shopping channels over there. But we compare only 3. We are the major ones. Those combined, all the shopping channels data is having a $2 million range.
2 billion.
2 billion.
Understood. Thank you.
Hello, I'm Preet from Centra Advisors. I want to understand how much of the demand does our own manufacturing capacity suffice and how much do we have to outsource? Matlab, if I can get a sense of our manufacturing capacity.
Sorry, actually, I didn't get that. Sorry.
I want to understand our manufacturing capacity. So how much can we ourselves manufacture and how much do we have to outsource?
So pretty much I think we have around, let me ask Raj, I think he can answer better about his.
So if we talk about the jewelry, we manufacture almost 95% jewelry, if we say. So our total sales volume is depend on the like sourcing. We do LSP products say around 30%, which is outsourced. Entire things is outsourced. About the jewelry, whatever we sell, we manufacture almost 90% in house.
Okay, and I want to understand more about more on the sales side. How do we exactly sell in the digital market? When it comes to the TV market, we run a show on a channel and we get calls. But what is our strategy in the digital market?
Yeah, so we advertise through Facebook, Google, through affiliates, and through influencers. And also we get our TV customers to transition to digital as well. With a customer who is only TV customer, when she transfers to digital as well, becomes multi-channel customer, the lifetime value goes 4 times higher. So we do a lot of emphasis on moving from one platform to other platform. It's highly valuable for us. So both ways, direct e-com through digital paid, SEOs, and through transfer from our television properties.
And other than our jewelry products, so which is one of the major segments in the non-jewelry segment, if I can understand, which is one of the major products that we sell in the non-jewelry segment?
Sure.
Yeah, so in UK it is beauty. Beauty contributes to about 18% of our business in UK, and after that it's home, which is about 13%.
So in US, the non-jewelry is pretty much distributed equally between apparels and accessories, home and beauty. But yeah, if you look at all three, beauty is the largest in US as well.
Thank you.
Hello sir, this is Pritesh Vora. So my question is about US and UK. We sell $50 products. So what is the income bracket of the people who purchase this product? And in this crisis, I mean, whatever we have seen in 2008 crisis, this income class getting affected because of that crisis. What kind of assessment we have if we see similar crisis now?
Yeah, so income group, average income group in US about $55,000. But we have many customers who have income group much higher, $100,000, $200,000, $250,000 as well. Because they are the people who are buying more investment kind of product like gold, or certified gemstones or certified jewelry. So we have faced in 2008, 2009 and also in COVID when people didn't want to buy. But we pivoted the product as per the customer demand. And that ability for us to agilely transform the offering to customer allows us to constantly be relevant for the customer.
And what sort of downturn we have seen during the GFC crisis in our business? If you can take us through 2008.
I don't have the exact data, but we've just started the business, the retail. We started 2006 in UK and 2007 in US. So I don't have, but there was not a substantial base there at that time. But it is true that nobody really wanted to buy $200 or $500 jewelry at that time because they were so nervous. What we did at that time to bring the price point down to $20 and change the product offering. And our sales really shot up. We started selling a product that they need that, for example, crazy glue that they would use to repair their clothes or repairing kits and all that. That really helped. But the lower price point really worked at the time. We were able to change that dramatically. And that helped the business, and in fact, that transformed our business completely to give value offering, which we did not have earlier.
So my next question is about the cord cutting, which is real, what we have data we are seeing here. So what is our gross margin in the TV product vis-a-vis gross margin in the other channel, digital channel, which we propagate? And how do you see realistically, do you see that TV can still grow from here, or what are your strategy towards if the cord cutting becomes increasingly very high in next few years?
Yeah. So Vineet has mentioned about cord cutting. We are seeing cord cutting happening in cable satellite, but we are seeing the homes increasing on OTA, that is antenna. Like you have antenna, which used to have antenna on the table, or on the TV. Now people have digital antenna which is built into TV. Some even have outside as well. And many of those OTA homes doesn't need even big antenna. Very small antenna is enough for them. In today's digital world, that is so ubiquitous now. That business is increasing. And we are seeing those customers spending more also because they have maximum say 100 channel compared to 1000 on cable. So we see a lot of potential coming in from those OTA homes. OTT, where people are going through connected, as Vineet mentioned in his slide, is also huge growth area. We expect 40% CAGR on OTT space. So we have, from a television point of view, we have a runway in front of us for next 8-10 years without any problem.
Okay, sir. Thank you. Wish you all the best.
Hello. Yeah, this side. So you mentioned that digital is now 40% of your sales. So just to get a broad sense, could you just help us understand in digital how much would be your own app, Amazon would be how much, Facebook, and other online apps. So just to understand, how is that growth coming and where is that growth coming from?
Yeah, so Amazon is just around 3% of our business. Amazon or all marketplaces put together just about 3% of our business. So that is part of the digital that we mentioned. And the rest is our own properties, our website, our apps, or our OTT streams.
The cost of acquisition for a customer here would be significantly higher than your traditional TV channel. Is that understanding correct?
This is a different way of mechanism. So our TV channel, we have our 24 live feed on all the platforms. That is customer acquisition as well as the current showroom for customer to visit and buy from us. So we can't really strip out the acquisition cost on TV. There's one showroom for everything, acquiring as well as selling. On digital, as we are becoming more and more understanding that space, our cost of acquisition keeps on going down. And we expect in mid-term, the cost of acquisition or the SG&A portion of digital to be similar to TV as well. Now, most of the major part of the digital right now is a TV customer that we transfer over to digital. But the pure digital that we acquire, the SG&A cost is slightly high. I don't have the exact number, but we are constantly learning and managing that to lower it, and we expect that to come stable and lower number in years to come.
And the customer set that you mentioned, the baby boomers and the Gen X, I think. So is it that the same customer is buying online, or do you think your online channel has a different set of customers and there may not be that stickiness that's available in the TV format?
Yeah, that's a good question. For our main brands, the Shop LC US, Germany and TJC UK, we are addressing the same customer. So on Google or Facebook, you can address certain customer segment. And that customer is better for us because the product that we have offering on our website, on our TV, is for addressed to that customer. And we want that customer to come in through those digital channels and get on the TV because the lifetime value is so much higher of a multi-channel customer. And we see that all the time. On the new launches that we did for D2C customers, especially the RACL designer brand, there we are addressing a little younger customer. And we're finding successes with that. Because we don't want to get the new customer coming in on our main business and get confused because the product is not suitable for that customer.
And so just last bit on the gross margins. So in your digital space, would your gross margins be similar to what you do in your other TV segment? Or because from what I understand is online, there's more price competitiveness. So going forward, as you tend to grow faster in the digital space, do you think gross margins you can maintain at 60? And what are they currently?
Yeah, so the gross margin for web is slightly higher than TV, just slightly higher. On the FPC portion of that, there is a catalog portion. The live stream TV live stream that goes through web is same as TV. Now the auction part is lower, much lower. But the auction is actually a combination of TV and web, because there is a leftover from televisions. The returns from television or the leftover from television. So it's a very omni-channel kind of model that we have, which builds on one another. But to your point, the catalog where we acquire digital customer is slightly higher than TV.
All right, that helps. Thank you so much.
Yeah, sir here. Thank you for the presentation. It was very informative. Sir, I have one question on our slightly mature business in US and UK. When you think about a new customer, in the first few transactions we are acquiring him, so obviously, like this is my hypothesis that we might be having negative margin for that customer. How much time and how many transactions does it take for that customer to become profitable over a period of time for individual customer basis?
That's a very good question. On television, for example, in Germany, we are at 17 purchases already within a year and a half of average customer who bought from us earlier. So Germany will become profitable in H2. So it takes about, say, on any new broadcast market that we go, it takes about a year and a half for it to become really stable, profitable, and continue to grow from there. Year to year and a half. On digital customer, we try to acquire a customer at about 1/3 of the lifetime value of a customer. And the lifetime value of a customer differs from product category and the platform that you acquire from.
And sir, how do you define lifetime value? Because if you there is no end to that life, right?
Yeah, so we for 2 years.
2 years.
So we consider the margin that we will get from the customer within 2 years.
2 years. Understood. And sir, when you think about, so we have fixed cost, a lot of fixed cost in our business, right? If you remove the fixed cost, how much is the contribution margin that we operate in? Typically, just a broad range would be helpful.
Yeah, so pretty much our variable cost is around 14%, including semi-variable it will be around 17%. Remaining is HR and our fixed cost. But there is also caveat that we are constantly working to improve our variable cost, like clubbing shipping improvement that we are doing in US that is helping to reduce our variable cost that we have done in cost rebase program. So the constant review processes, but fairly variable cost 17%.
And 17% of revenue you meant?
Yes, yeah.
Okay. So just a last question, more from a broader, if you look at last 5 years probably, we have gained market share and that's clearly visible. But if you were to think about it, what are the constraints to growth? Is this a more demand-driven constraint which is probably leading to this kind of market share gain, or is it more supply-driven? And it could be probably both. So if you can elaborate a little further.
So constraint is our own discipline of not burning money in acquiring customers. For example, OTA full power. Our penetration is less than 20% in the current OTA, more than 22 million homes with full power OTA. Full power means homes that are associated with CBS, ABC, or the national broadcast networks. If you want to go aggressive with them, we acquire those homes at expensive price. It will take maybe 3 or 4 years to break even. But we are focused on making sure the break even of that home happens within 1.5 years. So the constraint that we have to gain the leverage in our business constantly and a measured investment into getting the new reach to the customer. New reach through OTA, new reach through cable, digital, OTT, marketplaces. We could go aggressive, but then there will be diluted. And we have set up a criteria that we would increase our ROCE and have 60% gross margin and have leverage.
But sir, why not invest ahead, like invest significantly now for the future, like for faster growth? Is there a
same point that we made the investments last year, but then when you saw the headwinds that happened, we didn't know that headwinds will happen. Headwinds happen, so we want to be conservative and consistent. Be consistent with the dividend, be consistent with the investment that we are making, but not go overboard. So the point is that we will consistently gain higher than the market GDP, will gain the market share from competitor, but won't go crazy.
Sir, excuse me, sir. The basic custom duty on basically lab-grown diamonds, is being reduced from, for the seeds basically used to manufacture lab-grown diamonds, is being reduced from 5% to nil. So this lower cost of production by this reduction in this duty, how will it help us in the Elanza brand like which we are having?
So Elanza is not so much of created diamond, it is mostly CZ. So we started testing created diamond, but still it's very small size, market size for us. So it's not substantial to make that impact for us right now.
But going ahead, are we looking at lab-grown diamonds?
We've done some testing and it is reasonably well. Still the price point is quite high. The lab-grown diamond, as you know, is cheaper than natural, but they're all clean. And so the price you don't get is less than $300 a carat. And our average price point is only $50. We do sell some higher as Shrikant mentioned, but that's not a huge amount of our sales.
Thank you.
Good evening. Currently, your market share is around 1 to 2% in US and around 10% in UK. So, where do you see this number going in next 5 years?
So we give guidance of consistently 15 to 17% growth for midterm. For next financial year, we have given the guidance of 8 to 10%, and because of the headwinds that we are seeing, but we only give that guidance. And as it was mentioned earlier, the GDP growth is only 3 to 4%. We are going to go 15 to 17%, assuming that the rupee won't devalue much. That's the growth that we see.
Hello. Thank you.
Hello. Good evening, sir. So I have two questions. First is, given our target customers like Gen X and baby boomers and Japan's population mix, so why didn't we foray in Japan earlier? So that is one of the questions. And the second one is that we recently have an IT raid in India, right? So any colors on that? If you can give.
Yeah. So the reason we didn't go to Japan because we went to Germany first, and Germany was more familiar for us, and we feel comfortable about it. And now, once we have German fully stable, growing very well, very profitable, we would have enough investable cash, then we can go to Japan next. Japan, we feel comfortable because we've sold to B2B in Japan in the past, so I'm quite comfortable with that. We have connections there, we have understanding of the market a bit. We understand the market product as well because we sold to Japan quite a bit. So there's the comfort level. But that will happen, I suspect it will happen anywhere between 3 to 4 years from now. Not so much. Our IT raid happened about 2 years ago, but everything is okay. We never have any comments, any raise of demand from those parties.
Good evening, sir. Varun here from Choice Equity. Sir, I perceive we are largely still a television marketing sales player, targeting customers about the age of 45. Although we're experiencing solid traction in the digital space, however, a general notion would be that digital media, has a younger audience. Considering your business model, are you looking at expanding your product portfolio to target a younger audience? Maybe that could fuel the next leg of growth, and more importantly, trying to understand your marketing strategy over here. Since we are also expanding into lifestyle and beauty-based products, it's a very competitive space. And what kind of an investment are you looking at to, fuel this next leg of growth?
Yeah, so from the addressable audience point of view, our audience is 40 to 70-year-old female Caucasian. We have some Asian, we have some Hispanic as well. And that segment is increasing day by day because people are living longer. And that segment has disposable income and have time on their hands. So this is a sweet spot for us and expanding. We don't really need to go much around for the different audience. Now, as you saw, our market share is still about 2.83% for US and just 10% in UK. So there's so much more growth potential within that audience for us. Having said that, we are still testing one D2C brand called RACL in a slightly younger audience, not too much. Instead of 45 up, they're going 30 up. And we are seeing good traction there. But we don't want to change the audience on our television because the television is watched by a relatively older audience. and we are happy with their audience.
So you found your competitive edge, and
it's a sweet spot, and that audience is growing. Have money and time.
In terms of customer acquisition investment, what kind of a percentage do you look at when you're trying to acquire new customers? Percentage of revenue from?
Yeah, so we look at lifetime value point of view. From a digital point of view, we try to acquire a customer at 1/3 of the lifetime value of a customer. From TV point of view, it's a different mechanics, because same TV channel is for acquiring customer as well as for selling to a customer. But we want to make sure any new market that we acquire that becomes profitable within a year or year and a half.
And so what really is the difference in CAC between TV and digital? Digital would be, of course, be cheaper.
So for TV, it's very difficult to figure out CAC, because same medium you're using to acquire customer as well as to sell. Right? Because once you acquire, same customer is coming back again and again. How much you attribute to the repeat purchase? Our repeat purchase on television is very high. So very difficult to attribute. So we don't really go into that area at all. We think how much repeat purchase we can increase, and what is the new customer acquisition speed of that customer, that audience is. And overall, we have to make sure that the market becomes profitable with new as well as repeat purchase within a year and a half.
Thank you, sir. Thank you for the answer.
So this so just wanted your thoughts on capital allocation. I think sometime back we'd got a head office or some office in Austin. So just wanted to understand, I think we paid about $42 million for that, and I think our annual savings were about $1.5 million on for that purchase. So just wanted to get some sense from you, what was the rationale for that, because my payback says 20-21 years of payback for this. So just your thoughts on that.
So we bought the land only. So the land is at a prime location in Austin. It's about 28 acres land. We paid about 12 and a half, 12 million. So we paid 12 million for that, and we still own it. So we are still in the process of finalizing the plan for construction over there. And it is not fully firm yet, because the interest costs have quite gone up. So opportunity cost is higher now. So we are revisiting that plan right now. So thank you very much. Thanks everybody for coming to our conference and for your intelligent questions and keeping us responsible. And if you have any further questions, feel free to ask from Prashant or from Ad Factor. Thank you very much.
Just last message before we leave. So feel free to reach out to us in case you want to visit to our factories in Jaipur. So that will give a new glimpse about us, how we are able to give that unique USP to a customer.
So the high tea is served, so please join us for that. The management is available for some informal talks, if any.